Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, I'm Vinay Joseph and welcome to another edition of What is Driving the Market, where we look at key market events and address key questions on investors' minds. In today's podcast, we summarize the key takeaways and implication of RBI's latest monetary policy, which came out last Friday. The key takeaways from RBI's latest monetary policy review are as follows. First, the RBI kept policy rate, which is the repo rate, on hold at 4% and maintained its accommodative stance, which was in line with market expectations. Second, the RBI normalized the policy corridor to pre-COVID levels of 50 bps with the introduction of a new standing deposit facility or SDF at 3.75%. The SDF will be the flow of policy corridor now going ahead instead of the reverse repo rate, which was left unchanged at 3.35%, while the higher ceiling of the flow, which is the MSF rate, was also left unchanged at 4.25%. Further, the SDF would be without any collateral. Third, the RBI revised its growth and inflation projections for FY 2023. GDP growth estimate was lowered by 60 bps to 7.2%, while CPI inflation projection was revised sharply higher by around 120 bps to 5.7%. This CPI inflation projection factors in an average crude oil prices of USD $100 per barrel, along with other higher prices for commodities. Fourth, the RBI also reiterated its commitment to smoothly complete the FY 2023 market borrowing with a rise in HTM ratio or held to maturity ratio to 23% from 22% of banks' NDTL, which is the net demand and time liabilities. So given this regarding the policy implications, we think that the overall policy was in line with market expectations. However, the guidance and policy statement was decidedly hawkish, as first the RBI commenced with policy normalization ahead of market expectations with an effective 40 bips hike in the operative rate with the new SDF at 3.75%, which replaced the reverse repo rate of 3.35%. And second, the RBI guided to a withdrawal of accommodative stance as it put ahead inflation risk ahead of growth. So overall, in our view, the RBI is likely to hike policy rates by 50 to 75 bips in the coming 6 to 12 months amid rising inflationary pressures and quite strong earnings and economic growth. Faster policy normalization by the RBI and the US Fed is likely to exert upward pressure on bond yields. This is going to result, in our view, the 10-year IGB bond yield likely to trade around 7.25% to 7.5% over the next 6 to 12 months. So that's all for today. If you like this podcast, please don't forget to subscribe. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.